All right. Good evening, everyone. Thank you for joining us. I went and got a COVID haircut today, put a fresh pair of pajamas on for you, but you can't see much of me, and that's okay. We're going to get started now. I'm going to have Christian introduce the evening.
All right. Good evening, everyone. Thank you once again for joining. So this webinar is a new topic or a new series we're starting, and we're calling it Office Hours. Much like you would thinking back to your university or college days, office hours was an opportunity where you could go see the professor and just engage with some of the questions in more depth than you were typically able to do during a class or a lecture setting. So very much along the same thread, Derek and I decided it would be a great idea to start an office hours webinar to just go through some of the great questions we get in a bit more depth and just share some of the answers with all of you. So without further ado, we will get started. So once again, for those of you who have been on our previous webinars, just some mandatory housekeeping. So please keep in mind that this material is provided for educational purposes only and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of this information, please make sure to see a professional advisor for individual tax and financial advice based on your circumstances. All right, so with that out of the way, we can get into our agenda. So this webinar will be a little shorter than some of our previous topics, and here are some of the questions we'll cover. So first, we'll go into some of the new methods of claiming home office expenses for 2020. So for those of us like myself and Derek are now who are working from home, we'll go into the different methods that you can claim home office expenses. Then we'll go into some of the tax slips and other important information that you'll need during when filing your tax return. So we'll cover a few of the slips, what they mean, and some other information to be sure you file with your tax returns. Next, we'll go into reporting RSP contributions and how some of the intricacies involved with that. Next, we'll move into RSP to RRIF conversion. So when does this happen? What does it mean? And what are the mechanics? And finally, we will go through a fund facts document. So this is something that's sent out with whenever you invest in a mutual fund. We thought it would be a great opportunity to just walk through one together, help explain what that means, what are the important details to focus on, and just answer any questions you may have on a fund facts document. All right, Derek, did you want to get things started with claiming home office expenses?
All right. As they say, the government giveth and the government taketh away. So they're offering a new office home expense that's especially for COVID. Now, for most people, there's what's called a detailed or the traditional method. A T2200 is required. It needs to be part of your employment contract that you're required to work out of the home and pay some of your own expenses. And there's quite a detailed list of items that can be deducted and some that can't be. If you're using that already, then that's something you probably have an accountant with, and that's good. But they've offered two new methods for this year because of COVID. So if we take a look at it, anybody that worked from home, it's a new, just for 2020. They may extend it into 2021 because here we are at the end of February and there's still a lot of people working from home. So for this one, you don't need any receipts, no paperwork. You can just claim up to $400. Now, as I said, the government giveth and the government taketh away. There's a little asterisk there. The maximum is $2 per day. So you would have had to work 200 days from home during 2020, which most months have about 20 working days. So basically you had to be working from the beginning of March till the end of the year in order to claim the full $400. But if two of you are working from home, both of you can claim the $400. No receipts, as I say, on that. It's just basically you count up the number of days that you worked from home, and you can multiply that by $2 up to a maximum of $400, and that's a claim for the home office expense. The next method is they've got a new detailed method. If you think you've got more than $400 worth, you need receipts. It doesn't have to be part of your employment contract, but you do have to get your employer to sign what's called a T2200S, which the S stands for special for this year. So again, it doesn't need to be part of your employment contract, but if you've got other expenses, and there's a whole list of things that are much too detailed to go into right here. If you're claiming either this one or the traditional method, which I mentioned at first, which will come up in a moment as the third method, that's the regular T2200. If you're using one of those, you probably are working with an accountant or a tax professional, and likely a good idea, because it can be very tricky on what you can claim and what you can't. And especially if you work by commission, which is, or working from home as part of your employment contract under the traditional method, you know that you've got to keep receipts and all those things anyhow. So the above $400, again, that can be done. You need that form from your employer, and likely a good idea to consult a tax professional in preparation of that. Did I miss anything? That's really the key things on the, everybody can claim up to $400 without any receipts. So that's the biggie. Christian, did I miss anything?
No, that was a great summary of everything. And like Derek mentioned, there are a number of intricacies in terms of what we can and cannot claim. The expenses actually change. Derek kind of hinted at this. If you're a commissioned employee versus a salaried employee, they do allow for different expenses. So it's important. It's really, really important here, and why we didn't go into too much depth in terms of what specific expenses you can claim. It's really important here to make sure you consult with a professional tax advisor, just to be sure that you're claiming the appropriate expenses. All right, so next we're going to go on to tax slips. So these are the different slips that you'll get when you're filing your return, what they all mean, what the information is on them. So to start, we have a T1. Now, believe it or not, this T1 is actually your tax return itself. So this is the federal jacket outline. It's where it summarizes all of your taxes. So this one is not actually what you file with your tax return. It is your tax return. So the next one we have here is a T4. This is what most of you are familiar with. This is for employment income. So this will show any of your wages, bonuses, commissions, taxable benefits, CPP, EI contributions. These are mandatory contributions you have to make, any tax withheld at source, and any other employee related benefits. There's a few subsections of the T4. So a T4A is a slip with pension and annuity income. So if you're collecting any sort of employer pension, you'll get a T4A. There's a T4A OAS, which is for old age security. So very similar information on it. It just goes through it's for old age security. A T4AP is for Canada Pension Plan. So any benefits you receive from Canada Pension Plan will show up on a T4AP. A T4E is for EI benefits. So if you collected CERB this year or unemployment at any point during this year, it will come on a T4AE. There's also T4 RRIFs for any RRIF payments. So if you have a RRIF payment coming out either monthly or annually, that will be on your T4 RRIF. And then finally a T4 RSP if you made any taxable RSP withdrawals during the year. So these all fall under the T4 category, and they're related to pension and employment income. Derek, anything that on T4s before I go through some of the other slips?
No, that's all income.
All right. So next we have T3s and T5s. So these are for investment income. So when we say investment income, it's important to note that this is from investment accounts as well as bank accounts. So interest from a bank account would be considered investment income. So the reason there's two different slips is because it depends on the structure of the investment itself. So a T3 is for income from trusts. So this could be a bank account, it could be a GIC, different forms of trust income. This is essentially any investment that's structured to just pass along the income right through. So there's certain investments that are structured as a corporation, where the income goes into the corporation and then the corporation spits out the income. It's kind of a two-step process. This would be covered on a T5, whereas a T3 is just a trust income slip. So if you had, this is a little bit beyond the scope of the session today, but if you had any sort of formal trust, a T3 would also cover the income from that trust. So mutual funds, seg funds, GICs, ETFs would all come on these two slips. Any investment income, so dividends, interest, capital gains would all show up on, or capital gains dividends, I should say, would all show up on these two slips. There's a sub form under the T5 known as a T5008. So this is what reports any capital gains from your investments. So if you bought or if you sold investments throughout the year and report a capital gain or capital loss, the T5008 will show the cost base of the investment that you sold and the price you sold the investment for, and that will be used to calculate the capital gain or loss. Derek, anything to add on T3s and T5s?
Just a little bit more on the T5008. That's a relatively recent addition to the tax forms. You used to have to calculate your cost base and your proceeds from a sale of stock or mutual fund by yourself, and so you needed to get the year-end statements from the mutual fund companies. There was no T-slip, but I think the government caught on and found out that there was a lot of people didn't realize they had to do that and weren't reporting capital gains from stocks or mutual funds that they sold. And so they started saying, we think we're missing out on some income tax here. So they mandated that all investment firms would issue, and the first year or two was quite confusing because they issued only the amount that you received. So you sold something for $10,000, but they didn't have any cost base on there. So if you were doing it yourself, or if you missed the slip, the government would say, oh, you sold something for $10,000. There's no cost base shown in. We're going to tax you on the whole $10,000. So now, after a year or two of that, and a lot of, I guess, nasty letters and so on to CRA, and some friendly input, they now have all the investment firms putting the actual cost base on there. So it makes it a lot easier for people, and they don't have to keep track of individual stock or mutual fund purchases that they made throughout the years. There are a couple of other T-slips that occasionally people might find, sometimes a T5013, which is for partnership income. And I haven't used these for a number of years, but a number of years ago, I offered limited partnerships that were tax shelters. Some were in oil and gas, some were in real estate, and so on. So there are still a few of those around. So depending on your investment circumstances, you might come across a T5013, which again lists the partnership income, deductions, and so on that are with that. So that's it on the T-slips as far as the income.
Yep. And for some of you who are observant, you may notice I see a T1, a T3, a T4, and a T5. What about a T2? So T2s are a corporate tax return. So if you have a corporation, your tax return comes on a T2 slip. We didn't include it here as most cases it's, once again, much like the T1, it's not something you have to file. It is produced by the accountant, and we are sticking to personal tax slips. It's important to note most tax slips are issued within 60 days of the year end. T3s have 90 days. And all of your slips, if they haven't been mailed to you directly, they will be available on your My CRA account. So you can go right in and download the slips. They're all uploaded. Once they appear in your My CRA account, that's just confirmation that they've been sent and received by the CRA. So those are all available on My CRA account. All right, Derek, did you want to take us through some of the other important tax information?
All right. So one of the things for those people that are still working and not retired, RRSP contribution receipts. We have, this is the last week that you can put contributions in and claim back on your 2020 tax return. It's the only investment that you can make after the calendar year is over that qualifies for deduction to the prior tax year. So that's an important one. We'll talk a little bit more about that in a minute. For many people that have an open account, it's also called a cash account, investment account, a non-registered taxable account. If you're in a fee-based arrangement, then there will be a charges and compensation or management fees report. Those fees for non-registered accounts or taxable accounts are tax deductible. So the government is fair that way. If you're paying fees for management of taxable investments, because you have to report the taxable income, interest, dividends, capital gains, they also allow you to write off expenses related to that. That typically will come in with your December 31st year-end statement, or there may be a separate tax package that comes, again, depending on the type of investment you're in and the firm that you're dealing with. Couple of other things, receipts. You do need receipts for medical expenses. And again, most people are filing online, or their tax professional is filing online. So although you need to keep the receipts for medical expenses, not anything gets sent in. If you're still doing a paper copy, then yes, you need to include all your medical expenses. You'll get a credit for eligible expenses above $2,441 or 3% of your income, whichever is lower. So if you've got a high income, but you've got lots of medical expenses, then anything above $2,441 is a benefit to you. You'll get a credit for it. If you've got, if you're married and one spouse has a very low income, you can use the lower income spouse to claim the medical expenses for. Then we get into charitable and political donation receipts. So both of those are tax deductible. And the charitable receipt, the first $200 is the lowest tax credit, but the amounts above $200 are at a higher tax rate. And so literally, people, even if they're in a relatively low tax bracket, get a big receipt or a big refund based on charitable donations above $400 or above $200. And again, you can lump together charitable receipts, same thing as medical expenses, to one person in the household can claim them all. So again, you want the person with the lowest income claiming the medical expenses, and likely the person with the higher income would claim all the charitable expenses. Political donations are also tax deductible. They get a very generous tax credit on contributions to political parties. Now, if you have rental property, well, that'd be like an Airbnb, be a cottage that you rent out sometimes, where you actually have a rental property. Your rental income needs to be reported, but all of your expenses can be deducted from that, so that you'll end up with, you might have $15,000 worth of rental income, but if you've got a big mortgage on the property, property taxes, all those other things, you might end up only reporting a couple of $1,000s as net rental income. So just as an aside, net rental income also qualifies for RRSP contributions. So even if you don't have a T4 slip that says you're getting salary, but if you have a number of rental properties, then you are eligible to contribute 18% of your net income, which net rental income is part of that. So that can give room for you to put money into an RRSP and offset some of that income as well. There are also some private investments. You may own shares of a private corporation. You may have private loans, either through a lawyer, second mortgages. You may have just loans or investments with friends or family. But if you are claiming any kind of, or if you're earning any kind of interest, CRA expects you to report all the income that you have from anywhere in the world. So they talk about those little tax havens and offshore investing, all those things. CRA doesn't really care where you got the money invested. You are supposed to report all of your net income from anywhere in the world, as long as you're a Canadian taxpayer. So if you have loaned money out to a private corporation or an individual and you're collecting interest on it, or you purchase shares in an investment and you're receiving a dividend from them, again, if it's a private corporation, you won't necessarily get a bona fide tax slip from them, but you will have to report interest, dividends, capital gains that you earn from them. So suffice it to say, if you have more than a couple of T-slips, it's probably worthwhile getting a tax professional to help you with your tax returns. And it's not really rocket science. Especially the computer programs are pretty good at things, but a lot of times the tax laws will change a little bit from year to year, and if you don't know what questions to ask or what to look for, you could be missing something. So, did I miss anything on that, Christian? Anything that you have to add?
Oh, that was great. Really covered everything. And like Derek said, it's important. We really believe in consulting a qualified tax expert if you had more than just a few T-slips, because some of the rules and regulations change on a regular basis, and we want to make sure you're claiming not only all the available income and expenses against that income, but as well as making sure you've got all your receipts and you're getting all of the tax credits and tax deductions you're eligible for. It can make quite a significant difference if we're missing some of those expenses or some of those credits, and that's where a qualified tax expert can help you. So next we'll go into reporting RSP contributions. So Derek kind of alluded on this earlier, but we'll dive into this a little more in depth. So there's 2 periods, and you'll notice on your RSP receipts that they're earmarked either remainder of the year or first 60 days. So there's an important distinction between these two. If you make a contribution within the first 60 days of the year, you can claim that contribution in either the current year that you made the contribution or the previous year. So hypothetically, if I went and put in some money into my RSP today, I could actually claim it on my 2021 tax return when I file that next year, or I can claim it on my 2020 tax return that I'm filing now. One important thing to note here, with accountants, for most of them, they will generally default to claiming a contribution in the first 60 days in the prior year. We've had a few situations with this in the past where we've worked with a client to make an RSP contribution that happened to fall in the first 60 days. However, the intention was for the contribution to be claimed during the current year, not the previous year, which can result in a little more tax due than expected, especially if it's a larger lump sum contribution due to a large taxable payout. So it's really important when we're claiming contributions or dealing with accountants to communicate your intention for that first 60 days contribution, as most of them will default to the prior year. The receipts will tell you which are which, so it will distinguish between the two. Derek, anything to add on that?
Yeah, just we had a recent example of that where a client moved. This was before COVID, but moved from the big city out into the country, left their job, had a severance package, which got paid out in January of 2019, and some of it went directly into her RRSP. So we did tell her, say, look, please tell your accountant or keep this slip until next year, because your income is going to show up in 2019, and that's when you need the RSP to offset this extra income. And so, as fate would have it, she said, yeah, okay, I'll do that. And because we'd done the calculation, said, you'll get a little bit of a refund in 2000 for your 2018, but in 2019, if we use this RSP contribution, you'll only owe a little bit, and it won't be too bad. So, it was not until a year later she called up and said, well, how come I owe so much income tax? And we went back, she got a big refund because the accountant used it for 2018 and she had nothing to claim against the income in 2019. So ended up owing more than she had saved the previous year. And again, the accountant will say, oh, it's the first 60 days, we can use it back against the prior year. Why don't we get the money in your hands as soon as we can? But for planning purposes, we had tried to make it clear to her that it should be kept for the year that the income was received in. So it is very important to make sure that you use it during the calendar year that you want to use it.
And Derek brought up a good point with just going back to that example, if for those of you who are on our tax planning webinar, where we went over the difference between average and marginal tax rates, the more income you make, the higher rate in tax you pay. So if you're expecting an unusually high tax year, yes, you would still get a benefit from claiming that large lump sum RSP contribution for the year before, but you're going to receive significantly more tax savings based on the percentage or the tax rate or tax bracket you fall into if you're claiming it in the appropriate year. So you may say, well, isn't it just a wash? Because of how our tax system works with progressive tax rates, you would actually receive a bit of a different tax benefit. So it's really, really important to claim the RSP contributions in the right year, especially if it's an unusually high tax year. One thing to note, it's not so relevant anymore, but you actually don't have to claim all of your RSP contributions. Now, Derek, you may be able to add touch on this a little more in depth as to why this was done. With now we have tax-free savings accounts, and so it's not necessarily as common, but if you make a contribution to an RSP, you can actually carry forward that contribution. So hypothetically, if you were in a really low tax bracket and you wanted to contribute to an RSP, but it wouldn't really provide any meaningful tax savings, or it's an unusually low tax year, you can actually carry forward those contributions to the following year and claim them when you're in a bit of a higher tax bracket.
Yes, that's correct. Now you want to be careful that you haven't over contributed. You've still got to be within your limit, but you can basically say, yeah, I put the money in, but I don't want to claim it this year because I'm going to be in a higher tax bracket next year. So although I made the contribution, I'll get a bigger tax break. Sort of the opposite of that happened actually this morning. I was talking to a client who got downsized last fall, and I said, well, so, we had been putting a little bit of money on a monthly basis in to match up with her, to get her a little bit of a refund. And I said, so, like, do you have your T4 slip yet? Like, how much did you get paid with your severance package and all that? He said, company treated me really well. I still got my year-end bonus and so on, even though I was packaged off. And she sent me her T4 slip, and it was about twice what she normally makes. And of course, they'd taken a fairly significant amount of tax off, but I said, just based on this, it looks like you're going to end up owing probably an extra $5,000 of income tax just because of how it was paid out. So fortunately, some of that money she put into her just non-registered account. And so I said, well, great, we've got a few days left. We'll do a quick calculation and move enough from your non-registered account into your RRSP before the end of the month to make sure that you get at least a little bit of a tax refund on that, because she's currently unemployed, looking for work and hoping to find something. But when she goes back, likely it'll be at what her old salary was, which is about half of what she got last year. So I said, even if you save it until this year, you're not going to get as much tax savings as having put it in for the 2020 tax year just passed. So again, those are little things that oftentimes you don't get the T4 slips till right near the end of the year, but most people have a pretty good idea, or they'll have a year to date on their December 31st pay that we can do a calculation on to see if it's beneficial to put extra money into an RRSP in a given year.
So Derek, why don't you take us through RSP to RRIF conversions?
Okay, so this is something that causes a lot of confusion to people, or can cause a lot of confusion. It's really very simple. They just changed the last two letters. Nothing really has to change. The SP is a savings plan, and the IF is an income fund. So when you're working, you put money into a savings plan. The government gives you a tax break. They say, here, you can reduce your income and get a tax break on the money you put in. We're going to allow it to grow tax-free until you take it out. And then when you take it out, you're gonna pay tax on the whole thing. So literally, you could put a $10,000 in, make it grow to $1 million. You haven't paid a penny of tax on that money, but when you take it out, you're gonna pay tax on the whole $1 million. So some people would like to leave that in there forever if they don't need it, but the government says, okay, we'll give you that for a while, but you're supposed to retire at some point in time, and that's the whole purpose we gave you these tax breaks, was so that you would be able to be self-sufficient and help fund yourself if you don't have a company pension. So by the time you turn 71, or by the end of the year that you turn 71, you need to convert that to an income fund, and you're required to take a minimum out each year. And whatever you take out in any given year now becomes taxable income, and you have to pay tax on that. So your investments don't have to change. You can have exactly the same investments. We do have to open up a new account. You get a new account number, but literally we're picking up whatever was in your account as an RRSP. We're very literally changing the account number and changing the last two letters to an IF on it. And the next year, so in the year that you turn 72, is the year that we have to take your first income out. And it's based on either your age, or if you've got a younger spouse, then you can choose their age, because it's the younger you are, the smaller percentage that you're required to take out. At age 71, the first year, if that's your age and the age of your spouse, you're required to take out 5.28% of the value of your RRIF as of the December 31st year end. So if you had $100,000 in your RRSP when it converted to a RRIF, then you've got to take out $5,280 and pay tax on it in the next calendar year. So some people, that is their only form of pension. So for those people, we convert it and we have it paid out monthly, just like their pension check. Other people say, oh, this is good. I'll use it for a winter trip and a summer trip. So we pay it out in January and July. Or some use it, say, that'll be my Christmas fund. Can you pay it out once a year in December? So it's very flexible how you take the money out. The government doesn't care what you do with the money as long as you pay tax on it. So every year we have to take a certain amount out, and each year as you get older, the percentage goes up and up and up. Technically, you'll never run out of RRIF, because when you hit age 95, they top it out at 20% of the remaining balance. So again, if you had $100,000 left in your RRIF account when you're 95, you've got to take out $20,000 the next year. So that's going to leave you with $80,000. So unless you've got a RRIF that's growing at like 25%, it's going to shrink down, and it's going to be less and less and less, and it will eventually run out. So technically it won't ever run out, but it'll get very, very small, and most people will just cash it in. So the other thing is that not everybody needs that extra RRIF money. So we use it sometimes for people, if they don't need it immediately, we'll just pay the tax on it, put it in their tax-free savings account, and let it build and grow. They can then access it anytime they want, but there's no further tax on it because it's in the tax-free account. A couple of other important things. Once you turn 65, if you convert your RRSP to a RRIF, then it qualifies as pension income for the pension income credit. So if you don't have a company pension that qualifies for that $2,000 pension credit, you can convert your RRSP to a RRIF and get that, in essence, $2,000 tax-free out, because you've got an offsetting credit. And for some of our clients, actually many of our clients, when we do tax planning, we're looking at drawing their RRIF money out earlier than age 71. If they're in a very low tax bracket, or if the one spouse has no pension and has retired, well, we'll take some money out of the RRIF, oftentimes even before age 65, because at age 65, when CPP and old age security kicks in, they may actually have a higher income than prior to age 65. So it's a great savings plan. It saves you tax when you put it in to an RRSP. It grows for you, and it will provide you with a pension income of sorts. You have to do it by the time you turn 71, or in the calendar year that you turn 71. Your first income comes out at age 72. But oftentimes it's very good planning to take some of the money out prior to age 65 or 70 and pay tax at a lower rate. So again, tax planning is tied into this, and it's very flexible. Christian, anything to add?
No, that was great. You covered pretty much everything there. You mentioned it's very flexible. There's a minimum, there's no maximum you can withdraw. It is very important to get this right when we convert, or when we start making withdrawals, or how much we withdraw from a RRIF, because we'll end up paying anywhere from 0 to almost 54% tax on these withdrawals, depending on your situation. So making sure that we get these right. How much are we taking out? When are we converting? We are able to convert from a RRIF back to an RSP if you're under 71. So if you convert it at 65 because you thought you were going to need it, and all of a sudden you realize, oh no, I don't actually need it, we can actually unwind that. But it is important that when we start drawing from this fund, we are getting that timing right to make sure we're minimizing tax over your lifetime. What can oftentimes happen if we only take out the very minimum, it's great, we're not paying a whole lot of tax now. However, if you're hoping to pass on some of these assets to the next generation, when you pass away, if you don't have a spouse surviving you, that RRIF becomes 100% taxable. The government essentially says, well, you are smart, you are going to cash it all in the day before you passed away. So they tax the entire value of the RRIF as if you cashed it out the day before. So what happens is, okay, we take the minimum out for 30 years. We're 95. There's still a pretty substantial RRIF left in the account, and we pass away. Well, now that entire amount becomes taxable, and when you add on some of the other potential tax implications, so other sources of income that may come due around the same time, we could end up paying quite a substantial amount back in taxes, which essentially reduces the benefit that we received from that account over our lifetime to nil, if not a negative, because now instead of contributing when we paid 30% tax and taking it out when we only paid 20, we're paying 54% tax. A lot of numbers there, but essentially the one benefit with RSPs and RRIFs is that you contribute when you're in a higher tax bracket than when you take it out. So if it all comes due and you pay essentially one big lump sum of tax on your RRIF, well, then we lose a lot of that benefit because we're paying the highest tax rate. Derek, anything to add on that?
No, that's a good summary. So let's we'll have you walk through the fun facts.
All right, so I'm going to share my screen here. 1 second,
I'd like to think it's fun, but it has a D on the end of it, so it's fund facts. Much better than the 200-page prospectuses we used to do, because the fun facts are only 3 or 4 pages. So Christian we'll go through this in a very short period of time, but it has some great information, and most people will actually take a look at it because it is a lot shorter and a lot simpler.
Okay, let's see here. Lost it in all of my windows. Seem to have misplaced the fun facts. Just 1 second here. Sorry about that. Okay. So with the fun fact document, there's a number of different classes of mutual funds. So we'll cover just one, but we'll highlight the differences where you may see differences on the actual fun fact themselves, depending on what class of mutual fund it is. The different classes come with different fees, so that there may be some differences. However, we'll just go through one and explain it here. Okay. Share my screen here. Sorry about the delay. Once it decides to load. Technology is wonderful when it works. All right, there we go. Okay. So here we have a fun fact for the DFA Global Equity Class A. So there's a few important details that we'll go through. First off, when we mention the different class of mutual funds that are available, you'll see it denoted oftentimes in the name right here. So this is a Class A mutual fund. We'll get into the difference in a minute. So we scroll down here, you can see this is the date on the fun fact. So these are updated on a regular basis. So it's important to just make sure you're reviewing the current version so you have the most accurate information. So when you scroll down here, you can see a quick overview of some of the key details, how much is invested in the fund, the portfolio managers and any sub-advisors, minimum investment amounts. So if you're investing for the first time, how much you have to put in, any additional contributions, there's oftentimes a minimum amount you have to put in just for administration purposes. Here is one of the first key pieces of information, the management expense ratio. So this is the fee you're paying for this fund. So this would mean essentially, to give you an estimate of what the fee would be, you would take 1.54% of the amount you invested a year in fees. So if you invested $100,000, you'd take 1.54% of that, $1,540, and that is your fee. It's not exact calculation, so the exact amount is based on the average daily value in the fund. However, that's just a general way to understand what that fee means in dollar terms. There are some additional fees that can be included, which we'll get into in a second. So moving down here, there's the information on the investment mix, so what the fund invests. So you'll see a list of the top 10 holdings. In this case, there's only 7 in this fund because it holds actually a number of mutual funds underneath. But it'll give you the top 10 holdings and how much each holding represents of the total fund. It gives you a nice breakdown in a pie chart here, so you can see the different stock funds or equity funds, real estate fund here, a small amount of cash. This is typically just from fund money coming in and out of the accounts as individual investors buy and sell. And once again, the net other assets or liabilities is the same idea when funds are coming in and out at the time that this document was created. All right. So next we go into risk. So this talks about the risk of the investment itself. So the funny thing with risk here is it's actually the fund company that gets to classify how risky the fund is. So you can see here that it says Dimensional Funds has rated the volatility of this fund as medium, which essentially means the fund itself the risk is measured by volatility, which is essentially how far up and how far down the fund can go in 1 year. So the more volatile funds can jump up in value and lose a lot in a calendar year really quickly, whereas less volatile funds tend not to change a lot in value. So you can see the risk scale here. This is a medium risk fund that just goes through, once again, the risk and volatility. Derek, anything to add on that?
No, I think I'll add a little bit more when you talk about the other parts of risk, because there's about three different ways they talk about risk here, which I really like.
So next here, it talks a little bit about the past performance. So this adds a little bit more on the risk side of things. So you can see the annual performance net of fees from the past few years. So this actually just covers the past 8 years, and it also goes into the best 3-month and worst 3-month. So this gives you an idea over 1 quarter what kind of range of return we could expect. So in this case, the best 3-month period back in 2019, the fund returned almost 10%. If that was me, I'd be thrilled. But we also have to keep in mind what the worst return could be, which is down almost 12%. So either one of those numbers would be reasonable for this fund to get an average return of about 6%, which you can see here. So it gives you an idea of, yes, 6% is the average return we could expect. However, on a quarterly or even annual basis, we can see much larger changes in value. So it's just important to show you the importance of staying invested for the long term. Derek, anything to add on that?
Yeah, I really like this because this is a piece that I talk with clients often. The 3-month period, I think, is really important because most clients get a quarterly statement. So as Christian said, if you get a quarterly statement, and these two happen to end on a calendar quarter, so you would have gotten a statement if you owned this particular fund that said, oh, March 31st, 2019, you made 10% in 3 months. Aren't we awesome? But that followed a quarter that was just horrible, their worst 3 months, December 31st, 2018, when if you're looking at that and you go, oh, I lost almost 12%, Derek, why am I in this fund? Get me out of here. And so 2 things that show from that is oftentimes the best return comes right following on the heels of the worst return. And to further carry that along, it then shows out what happens on a year-by-year basis. So once you make an investment in the fund, you're not likely going to invest January 1st, but once your money is invested, it's now there going to be in each calendar year. So let's say it's now 2014, and you're looking at the fund, you're saying, oh, wow, it made 12% in 2012 and 22% in 2013. This is a great fund, double digits, no problem. So you buy it early January, so we make 6%, it's almost 7% in 2014. You're a little disappointed. Then the next year, it drops down even lower, still positive, but not making very much. Then we get to a couple of good years. Then 2018 was the bad year. So on. But you have to look at the long-term return. If a fund only averages 6 or 7%, and even most stock funds are high single digit over the long term. So when you see a fund or funds that have returned, 15 and 20% in 1 year, don't get too excited and jump into it, because if it's going to average even 9% and you just experienced a 22% return, it's not necessarily going to be 20% again the next year, or even maybe the 9%. To get to a longer term average, when you have had a couple of good years, at some point you're going to have a couple of lower years. So this is a really good way for people just to take a look at the volatility. And to me, I don't know, a lot of people I think would consider a 10% increase or decrease in 3 months to be a little bit more than a medium risk. But again, as Christian said, those are relatively subjective, and they're put in there by the fund companies. And compared to an individual stock, which can go up even much more or less in a quarter, I guess you would consider it medium risk because you're diversified. So that's I really like this part of because it really helps people get a better understanding of what risk is in a number of different ways of looking at it.
All right, thanks, Derek. So next section here, there's just a little bit about who the fund is for, so who should invest. Once again, as a medium risk fund, it's for investors seeking long-term growth. So this would not necessarily be suitable for somebody who's investing only for a short period of time. Like hypothetically, if you had a sum of money that you were looking to buy a car with next year, this may not be an appropriate fund for you because of the volatility that we saw in this chart here. That over 1 calendar year, that can be quite a significant change in value. So if we need the money in a relatively short time period, this may not be appropriate for you. So moving down a little bit about tax. So this just covers a little bit about how the tax works within this fund. So this is just talking generally about the difference between registered and non-registered funds. So because this is a trust structured mutual fund, like we talked about earlier, any fund distributions are included in your taxable income, so they flow right through. The fund doesn't do anything with the income. There are certain corporate class investments that are structured as a corporation that will take in certain forms of income that are higher tax, like interest, and only spit out lower tax forms of income. This is not one of those, so everything will just flow through directly to you. Moving on, so this is an important section we want to make sure clients understand, which is fees. So this is where it breaks down all of the fees associated with this fund. So we can see here the management expense ratio that we highlighted above of 1.54%. There is also a trading expense ratio, which is not included in that the MER that was highlighted at the top. In this case, dimensional trades vary infrequently, so it's a very low fee. For the total fee of 1.55%. So it gives a nice example of here, if you invested $1,000, that 1.55 would be about $15.50, just to get you an idea. In this case, if there's any sales charge or possible sales charge, that would be highlighted here if that's a possibility. This fund does not impose any sort of upfront sales charge or upfront commission. So you can see here, it says your representative of their firm may charge one. In our case, we don't charge any upfront commissions, and this fund doesn't have any embedded within it. There's a trailer commission as well. So this is where, going back to the difference between a Class A and other classes of funds. So typically a Class A mutual fund includes a trailing commission that's paid to the advisor. So oftentimes with accounts that are fee-based, this is separated out. So this fee would be a lot lower because there isn't in this case, a 1% trailer included in this fee. So this fee includes the advisor, it includes the fund manager's taxes and other expenses. Some funds, if they are Class F, for example, that would be a fee-based fund. It would not include a trailing commission, which is why there'd be quite a significant difference in the fee. So the trailing commission is essentially just an embedded compensation for the advisor, and it's not negotiated through any separate agreement. Derek, anything to add on that?
No, that's a good description. That basically wraps up what's in the fund facts. It gives you a quick overview of what's in the fund, how large it is, what the fees are, and the risk involved with it. So within 3 or 4 pages, you get a good synopsis of what you're investing in.
All right. And that is the fun fact. So we received a few questions prior to the webinar. So because now we've reached the end of the presentation. So we'll go through, it looks like we've seen a few questions come in as well throughout the session. So we'll get to those. The first question I'm seeing here is, how are vacation days considered in the temporary flat rate method? So this is going back to claiming home office expenses. I'm assuming the question is, if you have vacation days, are those days counted towards that flat rate method, or are they excluded?
Well, my thought would be you're only going to be able to claim $2 per day that you were working from home. If you're on vacation, you don't get to claim any expenses. You could verify that with an accountant, but that would be my understanding, because this is working from home. If you're on vacation, you're not working. It doesn't matter where you are.
Let's see. It's always important to clarify. Derek and I have a really good understanding of tax laws, but the accountants are really the experts here. So it's always best to consult with your accountant or your qualified tax expert with these kind of specific questions. The next one here is, when is the best time to buy RSPs? Now, there's not necessarily a best time in terms of during the calendar year. There's a few different ways to approach this. Oftentimes, a lot of people would set up a automatic monthly contribution. So this is a great way of doing it. You're making regular contributions every single month. In terms of a larger contribution, a lot of times why it's done in the first 60 days of the following year is because you are able to see all of your income and tax information from the previous year, which is why this 60-day grace period is there. We can look back in January and February and say, okay, this is how much money I made last year. And oftentimes this is actually what we do for a lot of our clients who are in this situation. I was actually running through this with a client the other day because he has 2 different jobs, one that pays a substantial amount of money and one that's a relatively small amount compared to his other job. So the job that pays the smaller amount, they don't withhold very much in tax because they only see, oh, we're giving you a pay stub for this smaller amount, so we're going to withhold a smaller amount of tax. Whereas his much bigger income increases his overall tax rate a lot higher. So what ends up happening is, come tax filing, he's stuck with a big tax bill because his one company that he works for wasn't withholding enough tax. So what we're able to do in January, February is look at his year-end pay stubs. If his tax slips aren't available, we can use some of the tax software we have that Derek and I use to do some projections. It's the same software a lot of accountants use, except we don't actually file the return, but we can do the projections and we can say, okay, you're going to owe $5,000 in tax this year. Why don't we make an RSP contribution? Here's a few different options and what that result would be in terms of how much tax you owe or save. So that's typically when we look at doing larger lump sum contributions. Another time would just be if there's a significant taxable event like a severance payout or something along those lines, a commuting a pension. So the timing is just very, very specific to your individual situation. It's not necessarily a good or a bad time. It's a very individual situation-based question. All right. So there's one question here on oil stocks. How are oil stocks doing right now? Derek, did you want to take this one, or did you want me to? I've got, I think, a good answer for this one.
I'm having trouble with my volume here.
Ooh. All right. So while you work with that, I will answer this one then. So generally speaking, we won't comment on any specific stocks. Energy has recovered quite well this year. Looking at some of the indexes that represent energy companies as a whole, as a sector, they're up 25 to 30%. The sector itself, not every individual company, those can vary quite widely. With the COVID vaccine coming out, a lot of those traditional sectors that were really suffering, those traditional industries that were hurt during the pandemic, are starting to see a bit of a rebound, because there's more hope that, in the case of oil, that travel will become more frequent again. There'll be more gas consumption. So that's, energy itself is starting to rebound quite a bit this year. Hard to say if that's going to continue. It really depends on the kind of the pandemic and vaccine progress. But so far this year, they have recovered quite a bit. Generally speaking, we encourage all of our clients, and we recommend that they're very broadly invested, so that we're covering all sectors and we're not necessarily too concentrated in each individual sector. Derek, anything to touch on that?
No, that was a great summary, and yeah, that's favored or areas that were out of favor because of the pandemic, with hopes of the pandemic coming to an end in the not too distant future. Those are starting to recover. And so we'll have to see how this all rolls out over the course of the year.
All right, so the next one, what is the general mood of the population now when it comes to investing with the deficit and lockdowns in Canada?
It depends. If you're still on a regular paycheck or getting some kind of benefits, a lot of people are doing quite well. If you're, as some people don't qualify for benefits, have been laid off, it's a very rough time. So I don't think there's a general right across the board thing. It really depends on your personal situation. There is a lot of debt out there, both government, corporate, and personal, and it's not evenly spread across. So those people with larger debts, if and when interest rates, I mean, they will eventually go up. We're just not sure when. It doesn't look like they'll go up anytime soon. Or when their income stops, then they will be in a much rougher situation. And I think my microphone hasn't been working that well. I'm not on my regular computer, so I need to apologize if there's been a little extra reverb or something coming back from mine. If it's been coming through fine, great, but I did get one message that there seemed to be some reverb when I was talking. And I don't know, we have time maybe for one more question. Is there one more there, Christian?
Yeah, so there's one last question. Where do you see inflation in 9 months from now? This is a bit of a tricky one. There's been a lot of speculation that with all of the government surplus and government support being doled out, that we're looking at potential rapid inflation. It's really difficult to say whether or not that'll happen. Derek and I often joke that God created economists to make astrologists look good, because of the amount of predictions that they make and how many of them actually come true. It's a pretty low percentage. Funny enough, I remember looking at a piece that basically went through a number of major economists and said, if you would have pulled out your investments from the stock market and moved them into cash, whenever they said that the end is coming or there's a major recession coming, how would you have done over the next 5-10 years? And I can't remember the specific results in terms of each individual economist, but I can tell you that they weren't good. So it's really important to take whatever predictions you hear from economists with a grain of salt. They're making predictions based on historical information. It's not a perfect, accurate representation of what's going to happen in the future. So in terms of where inflation will be in the next 9 months, very difficult to say. Derek, any thoughts on that?
The other thing that we always talk about is that you have your own personal inflation rate. If you're spending a lot of money on food right now or housing, inflation is very high, because food and housing or building supplies, they've really gone up during the period of COVID, partly because of the COVID restrictions, the extra costs involved, and just the fact that there's a lot of people that can't do anything, can't travel, so let's build a deck, or let's reno our house. So there's a lot more price pressure on those things. So supply and demand on a lot of things. If you were able to travel right now, there's great deals on flights and all those things, but that's pretty restrictive. So each person has their own kind of inflation factor, and certainly people with on a fixed income, retirees or lower incomes, if they haven't got any kind of indexing against inflation, they will be more hurt by it because they tend to spend more money on those core factors, which if you notice, the government usually says if we exclude the volatile food and energy sector, then inflation isn't that high. So as long as you don't eat or drive, inflation is pretty low. But if you like to eat, if you've got kids in university, if you're looking at buying a house, those kind of things, your inflation rate's very high. So again, as Christian said, it's really hard to try and predict a few months in advance, but take a look at sort of what supply and demand is, and that will also have a big impact on where inflation goes. So,
All right, that's all the questions we had. Thank you so much for joining us. If you do have any other questions, please feel free to let us know. Send us an email. We'd be happy to answer them. We will be posting a recording of this once it's gone through the proper approval channels. So we will have a recording of this on the website. Derek, any final notes?
no, thank you very much for taking time and joining us. Hope you all have a great evening, and spring is just around the corner, and hopefully we can be outside and moving around a lot more and resume a more normal life before the summer is over. Bye for now.
Take care.